For many decades, the U.S. government has led among nations funding international support to poorer countries around the world. And although the entirety of that U.S. government assistance represented less than 1% of the federal budget, it amounted to almost 1/3 of all overseas development assistance globally. U.S. support for humanitarian assistance in particular constituted an even higher share of the global pie, amounting to about 43% of governmental funding for international responses to crises associated with conflict and disasters stemming from natural hazards. The entire system and footprint of U.S. foreign assistance has been undergoing massive change since the second Trump administration began. Amid the shifts and cuts that amount to a sweeping transformation, it is worth considering different ways of doing things and areas of innovation that are ready for scale because they are cost-effective, well-suited to where the world is going, and they leverage market forces and public-private partnerships. Today, I will look at some specific aspects of disaster risk finance and insurance. Disaster risk financing is an important set of solutions to help grapple with mounting physical risks like storms, droughts, flooding, and extreme heat. Extreme weather and related disasters are growing both in terms of severity and frequency. This can be catastrophic for many underprepared communities and countries, with ripple effects for U.S. supply chains and business investments, economic security, population movements, and American interests around the world amid geostrategic competition for partners and resources. Countries facing crises from extreme weather have various ways of dealing with the financial fallout, some of which are shown here. They must quickly use funds to respond, and that can mean tapping government reserves. Of course, many of the countries that are hardest hit by weather extremes are also quite poor and additionally highly indebted. Pre-planning for disaster financing, and especially the most predictable crises, is key to effective risk management. There are a range of ways to plan in advance for funding that will be needed rapidly, and a layered approach is often best. Some of these simply relate to prearranged liquidity through risk retention and involve things like clauses in debt agreements that pause or lower loan repayments during an eligible crisis, or contingent credit lines, which are loans that can be drawn down immediately once a catastrophe threshold or trigger is met. International donors can also enable the repurposing of some funds for a multi-year development project based on pre-agreed contingencies. Risk retention strategies like these provide much-needed flexibility. The World Bank, for example, has been in the process of expanding the use of such pre-arranged contingency agreements. Beyond flexible risk retention, there are also various instruments of risk transfer. And by that, I mean passing disaster risk on to the global capital markets. These include catastrophe bonds, which private investors can buy, generating resources that are then available as debt-free, rapid funding if a qualifying disaster strikes. Risk transfer instruments also include insurance, and that's where I'm going to dive in a bit more. To focus on insurance, let's take a moment to consider a couple of the examples: hurricanes on one hand and droughts on the other. In 2024, the Caribbean region suffered a lot of damage from Hurricane Beryl, a record-breaking tropical cyclone. It developed in late June and was the earliest forming Category 5 hurricane on record in the Atlantic Ocean. It ultimately impacted 8 Caribbean island nations. In Grenada, for example, total damage was estimated at $219 million, or roughly 17% of the country's gross domestic product. Similar levels of damage were caused in Jamaica and St. Vincent and the Grenadines. Barbados had less than $100 million of damage. Prior to the hurricane season, all 4 of these island nations had procured parametric insurance policies to protect themselves against cyclones through a regional organization known as the Caribbean Catastrophe Risk Insurance Facility, or CRIF for short. Parametric insurance is a type of insurance that is based on pre-agreed and monitored triggers, such as wind speed, rainfall, or groundwater levels. If the triggers are met, the funding is quickly released, facilitating a more efficient payout that does not require an after-disaster damage assessment. In the immediate aftermath of Hurricane Beryl, CRIF made payouts totaling $84.5 million to its affected member countries that owned insurance policies that had triggered. But these countries all had differing levels of coverage. As you can see, Grenada saw a payout approximately twice the size of Jamaica, and considerably larger than St. Vincent and the Grenadines. In Barbados, the storm did not meet the necessary payout triggers despite the damage that it caused, so they did not receive a payout through CRIF. CRIF was created in 2007 and was the world's first multi-country risk pool. CRIF offers parametric insurance to its member countries, backed by traditional and capital markets, with the goal of building country resiliency to disasters through prearranged financing mechanisms. After several years, it expanded its membership to include some Central American countries and coverage to include the fisheries sector. CRIF further diversified its portfolio and membership to offer parametric coverage to the private sector by expanding to a number of water and electric companies. By partnering with insurance industry companies, this regional risk pool has also expanded to the types of perils it can cover. For example, the reinsurance firm, Swiss Re, worked with CRIF to develop a product focused on excess rainfall coverage, which it could then offer to its members. Today, CRIF has 30 members and has facilitated 78 payouts totaling almost $400 million. So, catastrophe risk pools can generate much-needed rapid resources for hurricane recovery and other perils. Those risks also include the risk of drought. In the same time frame that the Caribbean was contending with Hurricane Beryl in Africa, Ghana was in the process of developing its first sovereign insurance policy for drought. After 2 years of planning and capacity building with internal stakeholders and external donors and experts, Ghana purchased its first sovereign parametric drought insurance policy through the African Risk Capacity, which is also a regional risk pool similar to CRIF in the Caribbean. In this case, assistance to pay the $1 million premium was provided by the German government. Very soon after that policy went into effect, drought levels exceeded the triggers, resulting in 2 payouts to the Ghanaian government totaling approximately $3 million. The African Risk Capacity is a specialized agency of the African Union. Through ARC Limited, the agency's sovereign risk pool and insurer, member countries have access to parametric insurance products. While the African Risk Capacity works to strengthen disaster risk management approaches, ARC Limited provides specific insurance coverage, such as Ghana's parametric drought policy. Currently, there are 39 members of the African Risk Capacity, and over 60 policies have been signed covering 72 million people since ARC Limited formed a little more than a decade ago. Recently, ARC Limited has partnered with the UN World Food Programme and the START network of NGOs through its replica program to allow these agencies to match ARC country insurance programs, building an additional layer of coverage on top of a country's sovereign insurance. These cases from the Caribbean and Africa are just a couple of examples within those regions of how insurance is being used and developed to build resilience. And other regions have also developed risk pools. One exists for Pacific Island nations, and another for Southeast Asia. Plus, there are many other forms of insurance innovation unfolding beyond the regional risk pool model. In fact, the next few years may be a particularly ripe moment for scaling up prearranged finance measures to better manage mounting disaster risks. And it can be helpful to think through that prospect in terms of supply, demand, capabilities, and strategic interests. Traditional crisis assistance is shrinking, and this will cause big strains on conventional approaches to disaster response. The changes include dramatic cuts to U.S. budgets and programs for long-standing development and humanitarian aid efforts. But other key donors have also been cutting back too. The entire system for international humanitarian aid is in flux. A critique of that system has been that, for the large part, It overly relies on costly responses after a catastrophe, with too little emphasis on anticipation and risk reduction. Another is that the funding is too often unpredictable in terms of amounts and timeliness. But in some cases, as we just saw in those examples, there has been a growing, if still small, share of support for more innovative prearranged finance that involves strategies for risk retention and risk transfer to global capital markets through macro insurance. Meanwhile, insurance and reinsurance firms have been developing and refining their offerings, including through the use of parametric products, which lend themselves to transparency and rapidity. This is certainly also connected to continuously improving capabilities to model certain types of catastrophe risks through better data and technology. That includes more pervasive satellite and remote sensing data and better analytics that can lead to more accurate information, risk models, and pricing. With regard to demand and strategic interests, for vulnerable developing countries, the issues around extreme weather and mounting physical risks are rising on their political agendas. They need systems that yield more predictable and timely funding. And this demand is happening in the context of geostrategic competition for the US, especially with China. It is a competition in which the United States is actively vying for partnerships in countries around the world that are increasingly prioritizing resilience. While China does have the second biggest market in the world for insurance, and now also boasts some of the biggest insurance companies worldwide, its insurance industry does not currently have the extensive global networks to rival those of the US, UK, and Europe. There is a window of opportunity here. Businesses also have a big interest in insurance because insurance lies at the foundation of the capital stack, enabling investments, and the risks that can be assessed have implications for business, supply chains, and workers. According to a recent survey by the World Economic Forum on perceptions of global risks, respondents ranked extreme weather events as the most severely impactful risk over the next 10 years. New approaches will require a focus on disaster risk management in cost-effective ways that leverage global capital markets. The United States has an opportunity to exercise a potential strength while shaping markets and standards. There is an emerging and growing chorus calling for a significant increase in prearranged financing across cases where it is applicable. Just this year, a high-level panel of experts on crisis protection recommended a tenfold increase over the next decade in the proportion of crisis finance that is prearranged. The United States should lean in. If the US were to take even 2% of the $15 or $16 billion it was recently spending annually on international humanitarian response and convert that into support for prearranged disaster risk financing, that amount would add up to more than all of the prearranged financing recently reported by countries to the OECD. Even with relatively little funding for the US, such an approach would mark a new direction while challenging others globally to step up. By promoting and leveraging insurance, the US could demonstrate a different model of engaging with developing countries that can showcase cost effectiveness, financial predictability, and market-oriented private sector partnerships. Within the context of geostrategic competition, doing so would also help developing countries create a base layer of catastrophic risk protection that they fundamentally need to manage risk and attract further investments. Practical steps for moving in this direction include expanding beyond the long-standing capacity now within the U.S. International Development Finance Corporation to de-risk investments through the provision of political risk insurance specifically. The U.S. should build a capacity through the Departments of Treasury and State to catalyze more macro insurance and other types of insurance policies and products across strategic emerging market and developing economies that build investor confidence alongside resilience. To do this in a productive way that is streamlined, the U.S. government should leverage existing mechanisms, including the regional risk pools that exist. It should also partner with like-minded donors and institutions, including industry-led groups like the Insurance Development Forum. And it should collaborate with industry firms from the US and allied countries. With all the change that is happening within US foreign assistance, policymakers in the administration and Congress should be asking, how can we build the foundations of new and better approaches to advancing American interests and developing country interests at the same time? For more on all of this, follow our research at the Sustainable Development and Resilience Initiative within the Global Development Department here at CSIS.